In late 2025, something truly wild happened in the world of finance. A market that had been globally connected for, well, centuries, just suddenly snapped in two. We're talking about silver. And for a brief, absolutely shocking period, one of the world's most critical metals had two completely different prices. So let's dig in and figure out how on earth that happened.
So get this. On Christmas Day, while the Western markets were mostly asleep, the price of silver in Shanghai shot up to a mind-blowing $85 an ounce. But at that exact same moment, the quoted price back in New York was just $72. That is a $12 gap for the exact same commodity. Just incredible. Now, this wasn't some kind of computer glitch. No way. This was a deep structural fracture. It was a massive red flag that the entire silver market was under an immense amount of stress. So you got to ask, right? How does a single global market just break?
All right, to get our heads around this, we're going to walk through 6 key steps. First, we'll look at that crazy price gap. Then we're going to rewind to a crisis in London that really set the stage. We'll explore the insane demand that lit the fuse, and then unpack this deep conflict between paper promises and actual physical metal. And finally, we'll see how China changed the rules of the game, creating a whole new global standard.
Okay, first up, let's dive right into that Christmas Day shockwave. That moment the market's hidden stress just became impossible for anyone to ignore.
I mean, just look at this breakdown. It really shows you the scale of this thing. While New York's paper market was setting one price, Shanghai's physical market was trading at a premium of up to 17.5%. That's not a market quirk, folks. That's the market having a full-blown argument with itself about what a real bar of silver is actually worth.
And what we saw in Shanghai has a name. It's a classic distress signal called backwardation. Basically, it's the market screaming, "I don't care about a promise of silver next month. I need the physical metal in my hands right now, and I will pay a massive premium to get it." It is the ultimate sign of a real physical shortage.
So what caused this desperate scramble for physical metal? Well, the story really starts 2 months earlier, with a historic squeeze in the London market that revealed the first cracks in the system.
In early October, a single, absolutely massive order for 1,000 metric tons of physical silver hit the London market. And the system, which mostly runs on paper promises of silver, it just froze. It seized up almost instantly. It was a huge wake-up call that the physical inventory just wasn't there.
And that's the absolute key here. This wasn't about numbers on a screen, it was a physical event. A frantic, real-world scramble for actual bars of silver, as paper promises were being called in and the vaults were coming up short. To stop a total meltdown, an emergency operation of just staggering scale was launched. Almost 1,700 metric tons of silver, weighing more than 100 double-decker buses, had to be physically flown and shipped around the globe just to plug the hole in London. The metal was drained from everywhere. 48 million ounces got pulled from New York. But, and this is the big one, a record-shattering 660 metric tons were exported from China, and that single decision would have massive, massive consequences. So what happened? Well, it's pretty simple. To save London's paper market, they drained the East's physical reserves. Just like that, Shanghai's buffer stock was gone, leaving the world's biggest industrial silver consumer dangerously exposed. But what was driving all this incredible demand in the first place that made the whole system so fragile? Well, that brings us to the real engine behind this whole crisis, an absolutely insatiable industrial appetite for silver. Now, here's something you've got to understand about silver. Unlike gold, which is mostly for investment, silver is a critical industrial metal. Today, manufacturing chews up about 60% of all annual silver demand. It's not just precious, it's strategic. And the single biggest driver of that demand, you're looking at it, solar. Fueled by the global push for green energy, the amount of silver needed for solar panels has quadrupled in just a decade. It's a simple equation. More solar panels means more silver is needed, and there's really no easy substitute. And it's not just solar, not by a long shot. Silver is an absolutely irreplaceable part of everything from your electric car and 5G network to the most advanced computer chips and even military guidance systems. This isn't optional demand. Our modern world literally can't function without it.
So this intense, real-world physical demand really exposed a fundamental fault line that's been rumbling beneath the surface for years, the deep divide between the paper and the physical silver markets.
You see, you're really looking at two totally different worlds here. In the West, especially in New York, the price is driven by paper contracts, basically IOUs for silver that almost never get turned in for the real thing. But in the East, in Shanghai, the market is all about one thing: getting physical metal into factories right now.
Now, we've seen silver squeezes before, right? The famous Hunt Brothers thing back in 1980. But this was nothing like that. That was all about a few rich guys using leverage in the paper markets. 2025 was completely different. This wasn't a speculative bubble. It was a crisis born from a real-world structural shortage of metal needed for industry.
Okay, so you might be thinking, hang on, why didn't traders just buy the cheap stuff in New York and sell it in Shanghai for a huge profit? That's called arbitrage, and normally it keeps prices in check. But in late 2025, a whole bunch of roadblocks, things like China's capital controls, high taxes, and just total logistical chaos, made that nearly impossible. It allowed that price gap to stick around and even get wider.
So how did China respond to watching its strategic stockpiles get drained just to save London's paper market? Well, the reaction from Beijing was swift and it was decisive.
Beijing basically looked at this situation, saw its physical metal being used to prop up a foreign financial system, and decided, nope, not anymore. They decided to pull up the drawbridge.
And on October 26th, right in the middle of all this chaos, the official announcement dropped. It put the entire world on notice. The days of China being the world's emergency silver supplier were over.
The new rules? Deceptively simple, but incredibly powerful. They completely scrapped the old system. In its place, they put a strict, state-controlled licensing system. From now on, the government in Beijing would decide exactly who could export silver, how much, and to whom. It created a massive strategic choke point on the global supply.
And what this does is it turns silver from just another commodity into a powerful tool of what's called resource diplomacy. It gives Beijing huge leverage over its global competitors who desperately need that silver for their own high-tech industries.
So, where does this all leave us? Well, what we're witnessing is the birth of a brand new global standard for silver, one where physical reality is finally calling the shots.
The bottom line is this. The long-standing tradition of Western paper markets in London and New York setting the global silver price, it's ending. Their price has become disconnected from the physical world. Instead, the real price, the price that factories are actually willing to pay for metal they can hold in their hands, is now being set in the physical market of Shanghai, the world's biggest industrial hub. The center of gravity for pricing has officially shifted east.
The great silver dislocation of 2025 was more than just a weird market event. It's a powerful lesson. It proves that when financial promises collide with physical scarcity, the physical world, it always wins in the end. It's a stark warning, and it leaves us with one critical question to think about. If this can happen to a market as old as silver, which commodity is next?